The broadcast is now starting. All attendees are in listen-only mode.
Why? No. Oh, good morning, everybody. Welcome to the ECAR Affiliate Committee webinar, Changes and Updates with Mortgage Lending in 2015 that you need to know. My name is David Johnston from Prime Lending, and today I am joined with Mary Beth Barber from CADIC and Leslie Robbins from Putnam Bank. Before we get started, can someone please type in on the questions on the right-hand side and let us know that you can hear us and we have no technical issues. Each panelist this morning is going to take 10 minutes to present their topic, and then we will take questions, which you can type in on the right-hand side. Thank you, Nancy. You can hear us. Great. Remember also that this webinar will be recorded and available on the ECAR website. So share it with your friends and your coworkers, please. All right, getting started, I'm going to start with a new program in 2015. Get that up on the screen. This is Fannie Mae My Community Mortgage, otherwise known as the Fannie 97. This is a conventional 3% down program with income limitations. Now, what we're going to do is review some of the guidelines, the key guidelines of this program. It is a 3% down payment for single-family residences, condos, and PUDs, planned urban developments. You can do multifamilies with this program, but it does require a 5% down payment up to a 4-family. 100% of the down payment may be gifted in this program. The credit score requirement is 620 or greater, and at least one borrower needs to be a first-time homebuyer. Now, this is a nice switch on this program in that you can have a couple where one of the borrowers does own another property, as long as one of the borrowers is a first-time homebuyer, which means they have not owned a home in 3 years. And also, the other property does need to be sold prior to the closing. Okay, but that is a nice twist on that program. Homebuyer education is required by one of the borrowers. The PMI on this program is between 0.57% up to 0.94%, and this is credit score driven. And this is a nice touch too, because the PMI is lower on this program when you have low scores. For example, if your score is between a 620 and a 640, your PMI, if you were doing a 5% down conventional, would be 1.15%. This program, it's at 0.94%. So it does benefit the lower score borrower. There is a 3% seller credit limit, and this you should make note of, because most of the time, if you're going to get the seller to pay for all the closing costs and the prepaids and the escrows, you usually need between 3.5% and 4.5% to cover all that, depending on what the taxes are on the property. So the borrower will need some extra money to cover the gap there. Also, reserves are required as per direct underwriting findings. When we put the loan through direct underwriting and it comes back with our approval, it'll tell us how many reserves are required, 1 month, 2 months, and we won't know that until we actually put the loan through underwriting. It might come back with 0 too. The nice thing is that the reserves can be gifted on this program. All right, go to the next page. The income limits on this program are listed here below. For Connecticut, New London County, Norwich, New London, the limit is $84,600. And the main advantage of this program is that it really fills a void for the low credit score borrower that wants to do a conventional loan without getting huge add-ons to rate. If your score is between 620 and 640, the interest rate on a conventional 5% down program is going to be about 1/4% to 3/8 higher than this program. The other thing that does advantage to the low credit score borrower is that the PMI is lower for the low credit scores than it would be on a conventional loan. The downside to this program is that PMI is required, and therefore your ratio requirements will be more restrictive. All right, you know, the guidelines usually they max out at 44.99%. Any back-end ratios above that will probably not go through. FHA would still be the program to go with in that scenario because they allow for the higher ratios. All right, so that's the Fannie 97 program. Let's go to the next slide. Another new twist in 2015 started on January 26th of 2015, and you might not have heard of it at all, but it's called collateral underwriting, or CU. And what it is, it's an automated evaluation tool of the appraisal that's done on Fannie Mae and Freddie Mac loans. Why are they doing this? Well, the number one reason Fannie and Freddie have to kick loans back to their lenders is because of appraisal issues. This takes time and costs money for both parties, and addressing it up front is their goal. So what happens with this collateral underwriting? Well, in late 2011, Fannie Mae began gathering data from millions of appraisal reports processed through the UCDP, which is the Uniform Collateral Data Portal. The data that was harvested is used to fuel this analytical tool called CU, which also might be called a risk management tool, and it creates a score on the report, and it assigns it a risk factor. So the CU messages and scores that come up when this is done are designed to highlight the aspects of the appraisal that may require further attention. Now, that's pretty much Fannie's way of saying, lender, please read the appraisal report where it's flagged to ensure that comments and explanations are provided by the appraiser to meet the standard guidelines of Fannie Mae and Freddie Mac. So how does this affect you? I mean, now that you know what CU is and that it's being done in the back, you know, between the lender and the mortgage companies, what does this mean for the home purchase? Well, so far, that's a good question because it's so new, it's still being figured out. What we can tell you, I've discussed this with about a dozen other lenders, and what I'm finding is that we really need to make sure that the appraisal does a good job up front, because if not, that CU is going to come back with a lot of flags and a lot of issues. The CU also might address better comps, and the mortgage company needs to interpret the CU findings. In other words, when the risk score comes back, they need to interpret that, the flags that come back, and the messages, and then address those flags and messages. When I've spoken to appraisers, their take on it is that this is just another review on top of the many reviews that are already done, and it's going to mean that more comments and more revisions are going to be required by the appraisers. Like I said, I've spoken to about a dozen other companies, and so far I have not heard of any major issues. Most of this is all done in the back room. You guys, realtors, don't even hear about it. It's done between the lender and the appraiser. I heard of one situation where a field review had to be done, and the field review did come out substantially lower, but it didn't kill the deal. The deal was still done. but is something that you should know about, and it is a change that has happened in 2015. All right. Any questions on any of those two changes in 2015? All righty then. Looks like we'll go on to our next presenter. Next presenter is Mary Beth from CADIC, and Mary Beth Barber. Go ahead.
Good morning. The survey of the market. Today I'm going to talk about the summary, just a quick summary of the CFPB rule changes. The CFPB is the Consumer Financial Protection Bureau. I will be speaking about a legislative update that you might not be aware of, and the smoke and carbon monoxide detector affidavit. What are the exemptions for that for? Starting on August 1st, 2015, there will be two new forms introduced to the closing industry. The loan estimate, which is the LE, will be 3 pages long. It combines the TIL and the 3-page GFE. The lender or your mortgage broker will be presenting this form within 3 days of application to the borrower, which is very similar to how the GFE works today. The closing disclosure will, or now they're calling it the CD, will replace the HUD-1 as we know it today. This will be 5 pages long. It combines the 3-page HUD-1 and the final TIL or truth in lending that we have today. Who will provide this document? There are 2 options. Just the lender or a combination of the lender and the settlement agent. Now, in speaking with national lenders, they've said they will provide this document. The local lenders have also said they will give the delivery of the document, but it will still be a combination of the settlement agent and the lender providing the form together. This will happen 3 days before closing. This is the big change in the industry. The loan estimate, or the LE, is the same as what you see today is the GFE, or the good faith estimate. Now, this can only be used on or after August 1st of 2015. A lender cannot say, I'm going to start incorporating this form now so that my staff can get used to it and get acclimated. It cannot be used until August 1st, 2015. The closing disclosure, or the CD, today is known as the HUD or settlement statement. That can only be used in conjunction with the loan estimate. So on July 31st, if a borrower goes into a mortgage company or bank and makes application, they will still get today's good faith estimate, and the settlement agent or closing attorney will close with today's HUD settlement statement. August 1st, the new loan estimate becomes effective, and then the new closing disclosure will be used for that closing. So August 1st closing probably won't happen until September, October, depending on the loan. The 3-day rule is really what will affect the timing of things. The policy is that the borrower must receive their closing disclosure at least 3 days before the closing. And a business day is considered every day except a Sunday or a federal holiday. The only time you have to start the clock again for the 3-day disclosure review is if the APR changes, there's a product change, say from fixed to variable, or an addition of a prepayment penalty. How do you count the 3 days? For a closing scheduled for a Tuesday, it would either have to be hand-delivered on a Friday. The courier or FedEx, if it's delivered by overnight mail, you would have to have a signed receipt the Friday before. Or if you were going to use the U.S. mail, you would have to put it in the mail the Tuesday of the previous week. A lot of people are thinking probably, why not just email it? With emailing, it's the same timing as I previously mentioned. The exception is you have to have a receipt for the email. So the borrower has to either send an email back saying, I received it. You have to have a confirmed receipt from your email. And the CFPB on their website has an entire, it's a multi-page document regarding e-signing and confirmation of documents. So if you sent it electronically, it would have to comply with their e-sign regulations. You're probably thinking to yourself, okay, you've talked about the lender, you've talked about the settlement agent, we're realtors. How does this affect me? Well, when you're sitting down with your borrower, writing up an offer, you're going to have to be aware of the timing. You're going to have to think about the 3-day review of the HUD settlement statement. You have to watch the timing between the commitment and the closing date. And all in all, really, in a relationship, whether it's professional or personal, communication is key. You need to communicate with your borrowers up front and let them know this is how the process is going to go. You're going to have to communicate with the closing attorney. They will need to get figures and adjustments to the bank a week ahead of time, if not 10 days before. So it's very vital that this communication happens and everybody's aware of how the process is going to flow. On your screen is a calendar which goes over on a purchase closing date. If the closing disclosure is delivered by hand on Friday the 6th, you start counting Saturday, then Monday is day 2. Day 3 of the disclosure date and the borrower having the closing disclosure in hand, it's okay to close on that day and schedule. If it's delivered by mail, you can see that it's an entire week. Tuesday the 3rd, you count your 3 days in the mail, you can automatically start counting that they've received their disclosure on Saturday, then go to Monday, and on Tuesday the 10th, you can actually schedule a closing. The way we envision this happening is the lender, the borrower, and the closing settlement agent are going to choose the closing date and have to back out as to what day they're going to have that final closing disclosure in the hands of the borrower. Don't panic. We have this covered. eCar has on Friday, April 10th, a sold-out, already booked live seminar which will go into detail about all these changes. More good news is that May 20th at 10 a.m. a live seminar will be held here, and June 17th at 10 a.m. there will be a webinar. The best part about this is the presenters. We have Toby Gristis of Waller Smith & Palmer and John Peck of Peck & Tedeschi, who, with their experience and knowledge, you're going to walk away knowing what's happening in the industry and go forward with that. The next topic is a legislative update that you might not be aware of. How many times have you been involved with a closing that gets postponed due to a missing written recorded maintenance agreement for a shared driveway or right-of-way? I've been there. I was a paralegal. I've been in the office, and it's not pretty. So the state of Connecticut passed legislation stating owners using a common right-of-way share the cost of maintenance in proportion to the benefit received by each owner. Therefore, effective October 1st, 2014, Fannie Mae waives the requirement for a written maintenance agreement in Connecticut. Now, unless you've come across this in your dealings, you might not have been aware, and the same goes with the lenders. You might have to educate the lenders that this is now effective for the state of Connecticut. And I know the smoke and carbon monoxide detector affidavit has been beaten to death, but something that we get calls on a lot at ECAR, at the closing attorney's offices, are who's exempt from providing this affidavit. So I've just listed who the exemptions are. And some of them, if you think about it, really make sense because the definition of an affidavit is a sworn statement which is signed by a person who promises that the information is true. So if it's an executor or administrator, a bank-owned property, they don't know what is the truth about the property. They're not, they don't know what the information is. They don't know the property. They're not familiar. So these are the exemptions for the affidavit. Does anybody have any questions on the summary that I've provided? If you have a question, please type it in now. Okay, the final segment will be presented by Leslie Robbins of Putnam Bank.
Good morning, everyone. I'm Leslie Robbins. I will be speaking about changes and updates for CHFA. Now CHFA will give a reimbursement for federal recapture tax. That's obviously down the road once you purchase your property. Change in income qualification. This is a pretty big deal. CHFA only looks at mortgagors, borrowers, income for income guidelines. We would no longer look at all the people, the working people in the household. The down payment assistance program has changed. Also, the underwriting guidelines have been modified. Borrowers may keep assets up to $10,000. Previously, it was up to only $3,000. The other biggie is CHFA will no longer look at 401k or other retirement funds assets. Private mortgage insurance is also no longer required on loans with 20% down. This is new also. CHFA allows financing of homes in 55-plus communities. RD, USDA, and VA funding fees can be included in the first mortgage. That was effective with loan reservations dated on or after Monday, June 16, 2014. CHFA will allow borrowers to finance the VA funding fee and USDA guarantee fee in the CHFA first mortgage loan amount on eligible purchase transactions. Lenders that originate CHFA loans insured by VA or by USDA may include the funding fee or USDA guarantee fee in the first mortgage loan amount, and the loan-to-value may exceed 100% of the subject property appraised value. The VA funding fee and USDA guarantee fee are only fees eligible for inclusion in the first mortgage loan amount on VA or USDA guarantee transactions. Also, borrowers will be eligible to apply for CHFA Down Payment Assistance Program, DAP funds, for closing costs only if applicable. When calculating the DAP amount, the funding fee or guarantee fee amounts will be excluded. That's quite big because it will allow more for closing costs on your DAP, as these fees will now be financed in the first mortgage loan. When applying for DAP, the combined loan-to-value, the LTV, on VA or USDA loans may not exceed 105% of the appraised value of the subject property. Just a quick review on down payment assistance, CHFA. Oh, got the wrong one. There we go. CHFA down payment assistance loans are available in conjunction with a CHFA first mortgage. In most cases, the DAP loan interest rate will be the same as the rate of the CHFA first mortgage loan. The minimum DAP loan is $3,000. The applicant must attend a free 3-hour homebuyer education class before closing on the loan. The CHFA down payment assistance program is a loan and must be repaid to CHFA. Just a quick reminder on that. The calculation, the maximum CLTV for a CHFA DAP loan is 105%. More recently, effective with CHFA loan reservations dated on or after February 1st, 2015, CHFA will allow lenders to calculate the combined loan-to-value for loans with CHFA down payment assistance using the base loan amount in place of the total loan amount. Following the revised guideline, lenders will calculate the CLTV with the first mortgage base loan amount, excluding upfront MIP, added to the total DAP loan amount divided into the sales price. If you look at the chart for your example, you've got a sales price of $160,000. Your first mortgage base loan amount is $154,400. The upfront mortgage insurance premium is $2,702. First mortgage loan amount, so that's the base loan amount plus upfront MIP for the current calculation. As of 2/1, you take the upfront away, and as you scroll down, you can see that that gives you $13,600 to work with, and both are still at $105,000. So your closing costs or your DAP loan on the old method is $5,298. Now, with the new method and the new calculation, you now have $8,000 that you can utilize for your down payment assistance program. The change on January 26th, new this year, on your upfront mortgage insurance premiums for all loan terms will save the consumer money. If you look at your charts below, for over 15 years and over 95%, it's 0.85. That's your monthly premium. If you look at your purchase money and your upfront, it's 1.75 of the base loan amount. So that's been reduced also. And that just shows you some other, on base mortgages that exceed $625,500, if that's applicable to anybody. A quick note, your HFA preferred program update is the minimum credit score requirements have changed. The minimum credit score for applications with loan-to-values less than or equal to 95% is 640. The minimum credit score for applications with a loan-to-value of 95 to 97% is 680. Minimum credit score of 680 will apply for all loans originated under the HFA preferred product with an LTV of 9501 to 97. And if you recall, the HFA preferred program is a conventional loan that CHFA does now. I've gone into putting this in also the required homebuyer education classes because this is important when you're trying to get somebody started, taking applications and such. Borrowers who are requesting a CHFA down payment assistance program loans are required to take a 3-hour homebuyer education class. CHFA also requires that applicants of the Home of Your Own program and home ownership loan programs attend this class as part of their loan process. Borrowers can only take a 3-hour class if they have a CHFA loan reservation number. Please do not send borrowers to this class who do not yet have a CHFA loan reservation. Borrower purchasing 2 to 4 unit homes must complete landlord education classes. If borrowers are purchasing 2 to 4 unit homes and are getting a DAP loan, they must take both the 3-hour homebuyer education class and the 3-hour landlord education class. All required classes must be completed prior to closing the CHFA loan. Please notify borrowers who are required to take a required class that they must complete the class well in advance of closing their loan. It is more beneficial to the borrower to take the class early on in the process. So basically, when you're writing a contract and you have so many days to apply, you want to stress to your buyers to get in and make applications so we can get them registered with CHFA, and we're not waiting to the last minute to get this done, because they will not be able to close unless they've taken their home buyer education classes. This just came through on CHFA, and CHFA is pleased to announce that we will soon be offering an online pre-purchase counseling. A bulletin will be sent out in the coming weeks which will give details of the effective date and how the counseling will work. In the meantime, I've included the pre-closing education class schedule starting April 1st through June 30th. And I've done just the basic area. Anything that you need out of the area for classes would be on chfa.org and the website. You can check on that for the county that you're looking to do the mortgage in. This is just a reminder, your new London County sales price limits. Refer to that when you're trying to get a buyer into the right program and obviously the right sales price. Windham County, same thing, sales price limits for Windham County, and the new London County income limits. And again, that's for, as you see on the top, it's broken into 1 or 2 people in the family or 3 or more. That's a guideline that has to obviously be written in stone. They can't change that. And if you have any questions, please type them in now.
All right, thank you very much, everybody, for joining today. If you do have any questions you think of later, just please email or call any of the presenters. And keep in mind that we've got the seminar that's on May 20th, live seminar here at ECAR with Toby Griffiths and John Peck. And then also on June 17th, there is a webinar at 10 o'clock. Again, talking about the changes in August to the closing statement. And this is recorded, so if you have anybody that wanted to show up and didn't, you can always have them go to the website and see it there. Thank you very much and have a great day.